what credit debt affects buying a home. Think about it. If someone reached out to you to borrow money, you want to know, okay, what's their behavior of paying back the debt? Before you hand over hundreds of thousands of dollars to the person borrowing the money, or before the bank hands over hundreds of thousands of dollars to you to borrow the money, they want to know, hey, wait a minute, I love the score, everything looks solid, but what type of debt do you have, right? What type of debt does the borrower have? Can they handle a couple $100,000? If they can, how much can they afford to pay monthly to pay the bank back or you back for borrowing that money? So how monthly credit debt affects buying a home is really important. Some people are like, oh, I have great credit. Why can't they just loan me the money? I make all my payments on time. Remember, you're borrowing hundreds of thousands of dollars. They want to know that besides the grade, that what other debts can you have? Can you handle more debt? And the way they do that is they want to go through your debt to income ratio. If you haven't seen our video on debt to income ratio on your mortgage budget yet, right? Make sure you click the link below and check out how to budget for a mortgage payment. So of course, it's your debt to income ratio. I don't use that word a lot. I actually used to use a lot, but I know a lot of people don't know what DTI is. It's your budget. The more debt you have, the less buying power you have. If you make $10,000 a month, it's just an example, you typically take your monthly gross income and you times it by 50% on a conventional loan, 55% on a government loan, and 43% on a jumbo loan, right? But this is an example for conventional. If you make $10,000 a month, so whatever your monthly gross income is, you or whoever else is going on the loan, take the monthly gross income times it by 50%. That means your max payment that you can afford for your mortgage payment and all your credit debts can exceed $5,000 a month. I'm not saying that you should go to 50%. I'm saying the banks on conventional will loan you up to a $5,000 a month monthly payment. The less debt you have, the better. But let's say you have no debt, they'll let you go up to 4,500, 45%. But with debt, 5,000. Okay. So if you had $1,000 a month in debt, you can afford a $4,000 mortgage payment. $1,500 a month in debt, a $3,500 mortgage payment. $2,000 a month in debt, $3,000 mortgage payment. $2,500 a month in debt, $2,500 mortgage payment. Of course, as you can see, the more debt you have, the less home you can afford. Or you're going to come in with a big down payment to keep the payment where it needs to be under the debt to income ratio cap, depending on the program, to qualify to buy. I did another example for you right here. How to afford $50,000 more home. So it's really important for you to know your monthly debts, and we'll go over that in a second, so you can qualify for more home. I took a $50,000 home. I know there's not that many homes in the United States for $50,000, but there are areas where there are $50,000. But even if your home is not $50,000, I just use that as increment. A lot of times people qualify for about $50,000 less than what they're happy with. Some people need that extra $50,000 or that extra $100,000. So on an FHA loan, which has a higher payment than conventional, if you have a really good credit, you got to go conventional. That's another one of our videos. But let's say worst case scenario, you have to go FHA. So on a $50,000 home, 3.5% down, if I took the principal and interest, PMI, so I added the PMI to worst case scenario. If rates are at 3%, $340 a month will get you $50,000 more home. When you look at your debts, if you pay down $340 a month in debt, that will give you $50,000 more home. If rates are in the 4%, you would have to pay down $370 a month in debt to get you $50,000 more home. Look at that, 5%. Interest rates are at 5%. You would have to pay $400. If rates are at 6%, $430. If you're trying to qualify for $50,000 more home, right? You can either drop the purchase price $50,000, which no one likes, come in with $50,000 out of pocket, or pay down some debt to eliminate that $340 a month if rates are at 3%. If you're trying to qualify for $100,000 more home, you would have to eliminate $680 a month in debt. If rates are at 5%, you would have to eliminate $800 a month in debt to qualify for $100,000 more home. And these are the debts, when they run your credit, that the lender's going to count against you. These are the debts you want to focus on. Revolving debt, your credit cards, anything you pay off, you can use it over and over again, is your revolving debt. Installment debt, things that have an ending to it. A car purchase, a car lease, if you finance jewelry, furniture, electronics, or appliances that have an end date, those are installment debts. Mortgage debt, right? If you already have a property and you got to count that property against you, mortgage debt is categorized differently, because mortgage debt, there's a revolving part. That's like a home equity line of credit if you have a line of credit, or there's an installment, right? A 30-year fix, 25-year fix. So there's revolving, installment, and mortgage. The fourth type of debt is your collections. Yes, we hate to talk about it, but they're out there. You do not count charge-offs against you or medical collections. But regular collections, yes, you can throw the charge-offs and the medical collections out the window. And there's another debt they do count against you that sometimes is on your credit report, sometimes not. Court order debt. If you have alimony, child support, if you lost a lawsuit and you have to pay money monthly, those right there are included in your debt to income ratio or your mortgage budget. And last but not least, government debt. If you owe money to the IRS, that debt will count against you to qualify for a home. Doesn't mean if you owe money to the IRS, you can't qualify to buy. That monthly payment does count as debt. If you owe back child support, you can still buy. You just have to count that monthly debt. So now that you know the debts that count against you, the next step is to verify your monthly credit debts. A lender has to run your credit. If you are serious about buying, the sooner you want to buy, you want a lender to run it. But if you're like, hey, I'm a year, 2 years from buying, if you're not in a position to buy, do not buy. But if you're in a position to buy, have a lender run it. But if you need to prepare yourself, go through Credit Karma. I do not like the credit scores on Credit Karma because they use Vantage Score 3, but you want to see your credit utilization, what your limits are, what your balance are, what the payments are. If you need to make a list of it, see what debts you can attack, what debts are going to fall off by the time you're going to buy so you can not count that debt. If that debt is under 10 months old, which we'll go over in a second, you might be able to omit the debt. Did you co-sign for somebody? You want to go through your debts. If you're not ready for a lender to run it, use Credit Karma. Remember, if you and your spouse are buying a home and it's a car that's on both your credit, you only count it once. You don't have to count it twice. Same thing, if you're an authorized user on someone else's account, that monthly payment does not account against you in your debt. So you want to verify the debt with a lender or use myfico.com or use Credit Karma. Depends on where you are in the home buying process. Once it's verified, now you want to tally up your monthly credit debts. If you have time, go to whatsamortgage.com, download our ultimate mortgage guide. In our guide, we have our monthly debt worksheet. You want to tally up your credit cards, your car payments, student loan, installment, collection, mortgage debt, court ordered, and government. Tally it up. Write down the name of the debt, write down the monthly payment, write down the balance, and how much left you have on it. So you can start playing and manipulating and see what debt can I cancel or eliminate to qualify for more home. So once you make a list of all your debts, and you can see, okay, I know what I'm going to attack. What debt can I get rid of to qualify for $50,000 or $100,000 more home? Once you have your list of your debt, you want to match up your debt to income ratio. We want to go back and take your monthly gross income and times it by 50% if you're going to go with a conventional loan, 55% if you're going to go with a government loan, right? USDA, FHA, or VA. Remember, if you have no debt, some people don't have any debt. The max can go up to is 45% max debt to income ratio on a mortgage payment, on a conventional or government loan. Remember, if you're going to go with a jumbo loan, your max is 43. Even with debt or no debt, the max is 43%, right? So once you're like, I make X amount gross, let me times it by 50%. That's my number. Let me subtract all my credit debts, all my government debts, all my court order debts. Once you eliminate your debts, whatever's left is your max mortgage payment. You're like, man, that payment can't get me a lot. Okay, now let me work backwards now. What debts can I eliminate? Take your monthly gross income of everyone who's going to be on the loan, times it by 50%. That's when you start playing the game. What debts can you get rid of? You know, your monthly gross income, you see a list of your debt. Cool. This is my max mortgage payment I can get up to, but this is what I have now because I have my debt. What debt can I get rid of? Let me attack the debt. And this is what lenders do all day. It's not rocket science, but it does take time. That's why you gotta watch our videos. So check out our videos so you understand how to qualify for more home. So you have the tally, you eliminate those debts, and you qualify for more home. And here are now the rules of tallying debt. Sometimes it's simple, sometimes it's hard. Here are some rules. Whatever monthly debt is on your credit report, that's added to your debt to income ratio. If there's a payment there, you add that payment. Unless it's a medical collection or a charge off, you leave it alone. Okay, if there's a payment, you add that payment except for medical collections and charge offs. Now let's go with collection with no payment. So if you have collections with no payment, if the total of all your collections, the balances are under $2,000, leave it alone. If the balance is over $2,000 or if it's $2,000 or more, you would add $100 a month to your debt to income ratio. So if you had $4,000 in collection, you add $200 a month to your debt to income ratio. You would add the $200 as the tally. So take the balances under $2,000, leave it alone. 2,000 or higher, take the balances, times it by 5%. That's what added. Student loans. If there's a payment on student loan, you would add that payment to your debt. Let's say there's no payments. So your student loan can be in different positions. If your student loan is in deferment or forbearance, you would take the balance, times it by 0.5%. For example, the average student loan is $30,000. If it's $30,000, you would add $150 a month to your debt to income ratio. That would be on your tally sheet, right? On the worksheet. If your student loan is in income-based repayment, whatever the payment is, you add that to your worksheet. If there's 0 payments, then you add 0. That's kind of like a hack right there. You have a student loan and it's an income-based repayment. If it's 0, they add 0. So that's how the student loan rule works. Also, now the cosigner. This is how it works if you cosign for somebody. This happens a lot. If you cosign for somebody, they have to make 12 payments first before you have a chance to omit the payment. That's why when we make a list of your debts, right, on that tally worksheet, you write down how many months are on it, how many months are left. If they made it less than 12 months payments, you can't omit the debt. They would have to make more than 12 months payment before you have a chance to eliminate the debt. If you're going with a conventional loan, you can omit that debt, right? This is more for installment debts. For a car loan or something you help them finance, if they made 12 payments and you're going conventional, you can omit the debt. But if you are going with an FHA loan, they're going to want to see the paperwork on the car, on the loan. If you are the main person on that car, you cannot omit the debt with a government loan. You have to be the co. You can't be the main. If you're the main and the other person's the co, you cannot omit the debt. But let's say you co-sign for a mortgage. If you co-sign for the mortgage, you're going to need 12 months. But after 12 months, as long as you didn't write off the mortgage interest and you can prove that you don't live in the house, you can omit the debt. As long as they're making payments on it and you didn't write off the interest. I see a lot of people, because they help someone co-sign for the house, they want to write off the interest and get some type of benefit out of it, and now it affects them qualifying for the house. Even though the other person made the payment, you cannot omit it if you wrote off any of the interest. So be very careful doing that. And last but not least, on the tally rule, installment debts. If you have an installment debt less than 10 months old on a conventional loan, you can omit the payment as long as it's not a car lease. On a conventional, less than 10 months, you can omit the payment. If you're going conventional, if you're going FHA, that payment has to be less than 5% of your gross income. So if you make $5,000 a month, that payment, if it's over $250 a month, you cannot omit it. So it's very important that you know this, so you don't go out there, oh, I can omit this or I can omit that. So that right there is the second factor in your credit that is used to qualify you for a mortgage. Of course, the first factor is your credit score. Now we know your credit score. Of course, next step is knowing your credit debts so you can see how to increase your buying power. Hopefully this video brought you a lot of value. Do me a huge favor. Save this video, share this video, and like this video. If you're not following us yet, definitely hit the subscribe or notification button so you're notified every time we go live or post new content, guys. All right. Thank you so much for watching the show. Let's get some Q&A.